So picture yourself standing on the deck of this massive cargo ship in the middle of the ocean.
Okay.
Alarms are just blaring everywhere. Passengers are, sprinting for the lifeboats. Everyone is completely convinced the vessel is going down. It looks like pure chaos on the surface.
Right, total panic.
Exactly. But if you were to somehow dive beneath the waterline, you'd find this completely different reality. You would see a team of engineers quietly replacing the entire underbelly of the ship with, like, solid titanium.
Oh, I love that analogy.
Right, so the surface is panicking, but the actual foundation is becoming indestructible.
And that disconnect, that exact disconnect between surface level panic and deep structural reinforcement, I mean, that is the defining theme of the markets right now. We all have this tendency to just obsess over the visible activity.
Yeah, the flashing red numbers on a screen.
Exactly. And we completely miss the fact that the actual engine room of the global financial system is being entirely rebuilt right beneath our feet.
Well, welcome to the week that was. Today, we are opening up a really dense stack of market digests and financial reports from the previous week to basically unpack this massive structural friction currently tearing through the digital asset space.
There's a ton to get through today.
There really is. Our mission for you today is to help you look past the ticker, because on one side of the ledger, you have retail traders and ETF capital just fleeing in terror over macroeconomic fears.
But then you look at the other side.
Right. Corporate treasuries and the foundational plumbing of global finance are quietly integrating digital assets at a pace we have literally never seen before.
Which, it requires a really highly analytical lens to parse out, because the market is locked in this severe tug of war. The metrics dominating the headlines suggest total exhaustion, but the back-end data, it points to a permanent rewiring of how global capital moves.
So let's start with the surface metric everyone actually watches, which is the spot price. Lately, it has been suffocating in this incredibly tight trading range.
Yeah, hovering between what? Roughly $73,000, $477,000?
Yeah, right in that pocket. And to an outsider, that probably looks like stability. But to anyone actively managing a portfolio, you know that a compressed range like that is essentially a coiled spring.
Oh, absolutely.
And we just saw the spring snap in the derivatives market. A brutal shakeout erased $930 million in a single cycle. I mean, the fear and greed index is currently paralyzed at 23, which registers as extreme fear.
We really need to break down the mechanics of how a wipeout of that magnitude actually happens, because it's fascinating. In the derivatives market, traders use leverage, right?
Right.
So they put up, say, $10 of their own capital to borrow $90 from an exchange, betting that the asset price will break upward.
Hoping for a big payday.
Exactly. But when the market is stuck in that tight $73,000 to $77,000 range, and then it drifts just slightly downward, those leveraged positions become severely underwater. The trader's initial $10 is just vaporized.
And obviously the exchange isn't going to take the loss for them.
Absolutely not. The exchange algorithms step in automatically. They liquidate the trader's position to protect the clearinghouse. So they mechanically sell the trader's asset at the market price.
Which pushes the price down even further.
Exactly. It pushes it down a fraction of a percent more, which triggers the liquidation of the next over-leveraged trader and then the next.
Like dominoes.
Yeah, it is this cascading mechanical flush of retail buyers who were, basically trying to front-run a macroeconomic recovery that simply hasn't arrived yet.
And that mechanical flush ties directly into this broader concept of the debasement trade sort of cooling off. The reports highlights the staggering data from JP Morgan.
Yeah, that data was wild.
Right. It shows synchronized massive outflows from both spot Bitcoin ETFs and physical gold ETFs. So capital is not rotating from one scarcity asset to another. It is abandoning the inflation hedge trade entirely.
And the psychological shift here is profound. I mean, for the past 12 months, the prevailing narrative driving the markets was that institutional allocators were buying gold and digital assets to protect themselves against currency debasement.
Right, as a hedge against inflation.
But when both of those core assets bleed capital simultaneously, that tells you the portfolio managers have fundamentally recalibrated their risk models.
And the bleeding is relentless. I mean, we are tracking a 10-day outflow streak from the spot ETFs, hemorrhaging over $2.96 billion. BlackRock's fund is leading the drop.
Morgan Stanley's trust saw its very first historical outflow, too.
Yeah, and Bitwise is outright liquidating two of their digital asset strategy ETFs, BTOP and BWB.
Wow.
So for anyone listening who might be unfamiliar with the plumbing of an ETF, think of it like a really rigid pressure release valve. When a retail investor hits sell on their brokerage app, the authorized participants, the massive financial institutions running the plumbing for the ETF, have to actually balance the books.
Right. They can't just ignore it.
Exactly. They mechanically dismantle those ETF shares and dump the underlying physical assets directly onto the spot market. It creates a massive mechanical supply shock.
And they don't have a choice in the matter. The authorized participants are legally obligated to arbitrage the difference between the ETF share price and the actual asset price. When retail sentiment turns fearful, that mechanical selling pressure is just unrelenting.
So imagine you are an institutional allocator managing a billion-dollar pension fund. If the ultimate inflation hedges like gold and Bitcoin are bleeding capital simultaneously, are you suddenly just no longer afraid of inflation, or are you retreating to the safety of high-yielding government debt?
Honestly, the quantitative models are screaming at them to take the yield. Inflation might still be sticky, sure, but central banks are keeping interest rates elevated. If you are that portfolio manager, you face a pretty simple binary choice.
Which is?
You can hold a non-yielding asset like gold and just cross your fingers and hope the price goes up, or you can park your billions in government bonds yielding over 4% entirely risk-free.
So in a high-interest rate environment, holding zero-yield assets becomes incredibly expensive.
Right. They are choosing the path of least resistance to protect their capital.
But wait, let's look at the other side of this. If billions of dollars are flowing out of ETFs and the mechanical selling pressure is that high, why hasn't the market collapsed completely?
That is the big question.
Right. Why is the price still hovering in the mid-70s? The answer is the corporate sector. Massive corporate treasuries are basically acting as a sponge, aggressively absorbing all of that retail supply. Look at Strive, Inc.
Yeah, their recent move was massive.
They utilized a preferred stock program to purchase roughly 490 Bitcoin in a single day.
And you have to put that into the context of the underlying network physics. Since the most recent halving event reduced the network's block rewards, the entire global mining industry combined only produces about 450 coins per day.
Wait, so a single corporation?
Yes, using a single financing vehicle, absorbed more than 100% of the global daily supply in 24 hours.
That is insane. And they executed that using their SATA preferred equity program, which pays a cash dividend, instead of taking on debt. Which means that insulates them from margin calls if the price drops.
Exactly. It's a very different strategy than what we saw with Strategy, Inc.
Oh yeah, formerly MicroStrategy.
Yeah.
They took a completely different, almost theatrical path over the previous week. They actually paused their relentless buying to repurchase $1.5 billion of their own convertible debt at a discount.
We should probably define convertible debt here because it really is the lifeblood of these massive corporate accumulation strategies.
Go for it.
So convertible debt is basically a bond. A company borrows money from investors and pays them a regular interest rate. But the convertible part means the investor has the option to swap that bond for shares of the company's stock later on if the stock price skyrockets. So Strategy Inc. realized their bonds were trading at a discount in the secondary market, so they just bought their own debt back. They effectively retired the obligation for less than they actually owed. It is a masterful balance sheet maneuver.
But while they were doing that, they triggered a massive market panic. They test transferred and then moved 411 Bitcoin, which is about $30.3 million, to Coinbase Prime.
Yeah, the market completely lost its mind over that.
Prediction markets immediately spiked, pricing in an 84% probability of a massive sell-off before the company simply pulled the funds back.
Which perfectly illustrates the extreme sensitivity of the market to corporate custody right now. When a single entity holds that much of the total supply, even a routine transfer to a centralized exchange for basic liability management is interpreted as an impending dump.
Right. Everyone assumes the worst.
But the reality is, the meaningful institutional accumulation isn't happening on public exchanges at all. It is happening in dark pools.
Yes, the dark pools. We're seeing reports of massive $1.3 billion block trades occurring in these dark pools off exchange. And for the uninitiated, a dark pool is basically a private financial forum or exchange for trading securities.
It sounds sinister, but it's just private.
Yeah, they just allow massive sovereign wealth funds or corporations to trade giant blocks of assets directly with each other without routing the order through a public exchange like Coinbase. Because if they did that, it would instantly crush the public spot price.
Exactly. The liquidity is moving silently. But we really have to look at the collateral damage of this sideways market, which is falling squarely on the actual producers of the asset.
The miners.
The miners. The network difficulty, which is the computational power required to mine a block, is rising relentlessly. But the asset price is flat. That combination just crushes their hash price, which is the industry metric for profit margins.
It is a brutal squeeze. I mean, BitFuFu just reported a $35 million net loss. DMG blockchain is literally pivoting 50 megawatts of their power capacity away from mining to host AI data centers just to protect their margins.
Because you cannot negotiate with the physical reality of mining. Their electricity costs are fixed, and they're often rising due to energy constraints, but their block rewards were literally cut in half by the protocol.
So they're trapped.
If the spot price doesn't double to compensate, they are mathematically forced to liquidate their own treasury reserves just to pay their utility bills.
Yeah.
Which, of course, adds even more mechanical sell pressure to the market.
I have to push back on the overarching narrative here, though. The industry loves to celebrate corporate accumulation. You always hear, corporate adoption is always good.
Sure.
But if entities like Strategy Inc. are moving large batches of coins to centralized exchanges to prepare for liability management, aren't we just replacing the systemic risk of retail ETF liquidations with a new, highly concentrated corporate risk? Like, is the network becoming too dependent on the balance sheets of 3 or 4 CEOs?
Look, I will argue that absorbing 100% of the daily mine supply provides a critical price floor during a macroeconomic panic. It stabilizes the network in the short term.
Okay.
But to your point, yes, the long-term structural risk is undeniable. Decentralization is the entire value proposition of a distributed ledger. When publicly traded companies hoard tens of thousands of coins, you are absolutely reintroducing centralized failure points.
Right. Because if a massive corporate treasury faces a severe liquidity crisis and is forced by its creditors to liquidate its holdings, the structural impact on the market would completely dwarf the ETF outflows we are seeing right now.
Without a doubt.
So if these corporate giants are buying, why is the broader market still so terrified of inflation? To answer that, you have to look at the physical input cost of everything in the global economy, which is energy.
Always comes back to energy.
Always. And right now, the most vital energy choke point on Earth is under severe threat. The reports detail massive friction in the Strait of Hormuz.
That strait is literally the geopolitical jugular of the global economy. It handles roughly 20% of all global crude oil and liquefied natural gas shipments.
And we are seeing direct military engagements there. U.S. drone interceptions, Iranian missile responses. There was a glimmer of hope with a diplomatic roller coaster over the previous week. A 60-day ceasefire memorandum of understanding was drafted.
Right, which would have required mine clearing and the lifting of blockades. And that actually briefly eased global oil prices.
But the deal completely stalled. Iran rejected the proposed terms, demanding $12 billion in frozen assets and outright control over the strait.
And you have to tie that back to the ETF outflows we discussed earlier.
How so?
As long as the Strait of Hormuz is threatened, maritime shipping insurance skyrockets. Energy costs remain artificially high, so supply-side inflation stays sticky. That forces the Federal Reserve to keep interest rates elevated, which, as we said, keeps capital flowing into government bonds instead of digital assets.
But the collision between this geopolitical choke point and the digital asset space is where the story gets really wild. The U.S. Treasury just executed Operation Economic Fury, seizing approximately $1 billion in Iranian crypto assets.
Yeah, that was a massive move.
And their specific target wasn't just like a random trading desk. They targeted a proposed state-sponsored blockchain protocol named Hormuz Safe.
And the architectural ambition of this protocol is just staggering. Iran was attempting to build a blockchain designed specifically to collect maritime shipping tariffs from commercial vessels transiting the strait.
And they were going to collect those tariffs in Bitcoin.
Yes.
I mean, we really have to pause and absorb that for a second. The U.S. government is seizing $1 billion of state-sponsored crypto, while traditional markets panic over oil supply.
It's all connected.
Exactly. If nation-states are now building blockchain protocols to collect physical, real-world maritime tolls, doesn't that fundamentally graduate Bitcoin from being like a volatile tech stock to an actual sovereign geopolitical weapon?
It absolutely transitions the technology from a speculative financial instrument into a critical tool of sovereign statecraft. Look at the mechanics of it. A heavily sanctioned nation-state cannot use the traditional SWIFT banking system to clear international payments.
They're locked out.
Right. So they attempt to use a decentralized ledger to bypass Western banking infrastructure entirely and collect physical transit tariffs from global shipping conglomerates. It elevates the technology to a matter of acute national security.
It forces global superpowers to engage with the network defensively
Yeah.
rather than just worrying about regulating retail traders.
Exactly. But, geopolitics is flashy, right? The real permanent changes, the titanium hull we talked about earlier, are happening in the underlying plumbing of the traditional financial system.
The quiet infrastructure revolution.
Yes. For example, the Chicago Mercantile Exchange, the CME, permanently upgraded its digital asset infrastructure to allow continuous 24/7 trading for futures and options.
24/7. I mean, this cannot be overstated. Legacy finance has always operated on a 5-day schedule. Markets close on Friday afternoon, and they open on Monday morning.
But decentralized ledgers never sleep.
Right, which created the infamous weekend gap. So imagine you are a hedge fund manager holding massive positions on the CME. On Saturday morning, a geopolitical crisis breaks out in the Middle East. The spot price of your asset craters.
You're stuck.
Exactly.
Yeah.
Because traditional markets are closed, you cannot adjust your derivatives hedge. You are forced to carry unmitigated volatility risk for 48 hours until the CME opens on Sunday night.
Which is terrifying for an institution. By moving to a 24/7 trading environment, the CME is essentially admitting that legacy market hours are dangerously obsolete.
And the regulatory landscape is shifting just as aggressively. The CFTC made a historic move, approving fully regulated, physically settled perpetual futures for U.S. traders through platforms like Kraken's Binomial, Kalshi, and Coinbase.
We should probably clarify what a perpetual future is for the listeners because it is the dominant instrument in this market.
Yeah, break it down.
So a traditional futures contract is an agreement to buy or sell an asset at a specific price on a specific future date, say the last Friday of the month. When that date hits, the contract expires.
Okay, pretty straightforward.
But a perpetual future has no expiration date. It rolls over indefinitely. It uses a mechanism called a funding rate, which is essentially a small fee paid between buyers and sellers to keep the price of the contract tethered closely to the actual spot price of the asset.
So the CFTC approving these for U.S. institutions is what? A direct attempt to pull massive trading liquidity away from unregulated offshore exchanges.
Precisely. They want that volume back on shore.
But while the CFTC is approving these products, they are dealing with massive internal chaos. An investigative report revealed a purge of senior CFTC officials.
Yeah, the politics behind this are messy.
Really messy. These officials were reportedly trying to enforce rules against prediction markets, specifically Polymarket and Crypto.com, allegedly because of ties to the current administration's family. And internationally, Spain just outright banned Polymarket, classifying it as an unlicensed gambling mechanism.
The thing is, when regulators attempt to ban decentralized protocols, the developers don't stop building, they just engineer their way around the regulatory choke point. Because of these bans, decentralized platforms like Hyperliquid are now launching Oracle-independent prediction markets.
Let's explain how that actually works for the listener. What does Oracle independent actually mean in practice?
So in a standard blockchain prediction market, the network relies on a third-party data feed, which is called an oracle, to tell the blockchain what happened in the real world. Who won the election? What was the price of oil today?
Okay, so it pulls outside data in.
Right. The oracle feeds that data in, and the smart contract pays out the winner. But an oracle is a centralized point of failure that regulators can easily target and shut down.
Ah, I see.
So Oracle-independent networks don't use a third-party feed at all. The validator nodes that secure the blockchain run the newsfeed software directly themselves. The network reaches a consensus on reality by itself, resolving the contracts without any external dependency. It makes the market exponentially harder to shut down.
That is incredible. But the ultimate battleground, the true friction point between the old world and the new, is the banking sector. SoFi just launched the first bank-issued stablecoin on public blockchain.
Which is a huge milestone.
And MasterCard secured a New York BitLicense to scale their stablecoin settlement network.
Meanwhile, you have Jamie Dimon, the CEO of JPMorgan Chase, going on financial television to aggressively attack the Clarity Act, which is a legislative bill designed to create a clear regulatory framework for stablecoins.
He warned that traditional banks will fight stablecoin legislation tooth and nail. And why? Because stablecoins threaten to drain retail deposits from zero-yield checking accounts directly into high-yielding treasury bills.
It's an existential threat to their business model.
Think about it like a toll booth operator who has enjoyed a monopoly on a dirt road for a century, suddenly realizing a massive, frictionless superhighway was just built right next to them.
And the new highway actually pays drivers to use it.
Right. I mean, it's like the music industry realizing people can just download MP3s. We have the CEO of the largest bank in the world openly panicking about retail deposit flight. Regardless of whether the spot price of Bitcoin is flat today, isn't the real headline here that the traditional banking moat has officially been breached?
It is the defining financial paradigm shift of our era. Look, traditional banks operate on a very simple model. They take your deposits, pay you essentially 0% interest, and then lend your money out or invest it in government treasuries to capture the 4 or 5% yield for themselves.
Free money for them.
Exactly. Stablecoin issuers do the exact same thing. They take your fiat currency, issue you a digital token, and invest the fiat in treasuries. But because blockchain settlement is so computationally efficient, the stablecoin protocols can afford to pass the majority of that treasury yield back to the user.
Wow.
Jamie Dimon is not terrified of the underlying cryptography. He is terrified of the disintermediation. The legacy banking system is losing its monopoly on deposit yield.
Which brings us right back to our original mission for this deep dive. If you're only looking at the short-term ticker, the market looks exhausted.
It looks dead.
It is gripped by extreme fear, billions of dollars are flowing out of ETFs, and leveraged retail traders are getting wiped out in mechanical liquidations. But if you dive beneath the waterline and look at the underlying data,
the corporate treasuries swallowing the entire daily supply from miners.
Right, and the CME moving its derivatives to 24/7 trading, and traditional banks launching their own stablecoins while CEOs panic over deposit flight, you see a global financial system that is being permanently rewired.
The titanium hull is being welded into place even while the passengers on the deck are panicking about the waves. The infrastructure is hardening, moving from speculative retail playgrounds to institutional-grade, round-the-clock settlement engines.
Which leaves you with a fascinating concept to mull over on your own as this integration continues. Consider the collision between the Hormuz safe protocol we talked about and the banking sector's panic over stablecoin deposits.
It's a crazy intersection.
It really is. If nation-states are actively attempting to collect physical shipping tolls and digital assets to bypass sanctions, and retail banks are terrified of losing their domestic deposits to digital dollars, what happens to the very concept of a national economy?
That's the million-dollar question.
When money truly operates 24/7, without borders, without reliance on a single central bank's clearance window, how does a sovereign nation enforce its economic boundaries?
The boundaries of economic sovereignty are dissolving in real time. The technology simply doesn't recognize borders, and it certainly doesn't observe the weekend gap.
Thank you for joining us for the week that was. Keep questioning the headlines, keep looking at the underlying data, and remember, just because the deck looks chaotic doesn't mean the ship is sinking.
Sometimes it just means they're upgrading the engine.
We'll see you next time.